Good morning. Today we are going to talk about risks associated with investment in stock markets and how to mitigate them. If you look at last 25 years of data, Sensex has gone up from around 3,000 to 30,000, which is around 10 times return. So it is a 16% post-tax return, which is a substantial return. But if you look at how many Indian investors have benefited from it, the number is very meager. Only around 4 to 5% of Indian investors invest in stock markets. Most of our companies are today held by foreign investors. So the question is, when so much of wealth is being created by Indian companies in the Indian stock markets, why are Indian investors not participating in it as much as they should? The answer lies in the risk perceived to be associated with the stock markets. A common investor sees stock market investment as a high risk investment. So today we are going to talk about what exactly are these risks and how one can mitigate them so that more and more people can invest in stock markets. So there are three risks associated with investment in stock markets, which can be broadly classified as market risk, valuation risk, and stock specific risk. When you say market risk, it is about short-term to medium-term movements in stock markets. So today if you invest in a stock, but unfortunately because of the external circumstances or changes in market sentiment, the market goes down and your stock price also goes down. Now it can lie low for some time, say maybe 6 months, maybe 1 year, maybe 2 years. But it is only a notional loss. It is not a loss unless you have booked the loss or you have sold the shares. Now, in a growing economy like India, which is growing at 6 to 8%, these stock markets are not going to lie low for a very long period of time. Over a period of time, they are going to again come back and give positive returns. So, in this case, what happens is, if you have a long-term horizon and you are investing only from the money which you don't need for short term, then even if the market prices fall, you are not forced to sell. You continue to hold the shares, and over a period of time they again come back and give you a positive returns. So my point is, you should invest only the money which you don't need over next 1, 2, 3 years in stock markets. In that way you can mitigate the risk of market fluctuating over a short to medium term. The second risk associated with stock markets is valuation risk. Sometimes you don't know what is the right time or right price to buy a share. So you may end up buying a share at a higher price. This is a valuation risk of buying stocks at a higher price. But it is not such a serious risk, because if you buy a stock at a higher price, what it means is your potential returns are going to get reduced. But if you have bought a good stocks for a long period of time, you are going to get returns. So it's a risk, but it is not such a significant risk that people should be too concerned about this risk. The third risk is the stock specific risk, and which is the most important risk, and this is where maximum mistakes do happen by investors. This is investing in wrong stocks. Now if you invest in a wrong stock, even if the market goes up, the stock may go up for some time, but over a period of time the stock will find its own value corresponding to its business. So if you have bought a wrong stock, over a period of time you are bound to lose money. And that is the real risk associated with investing in stock markets. Now, how one can mitigate that is two ways. One does your own research and identify good stocks and invest in them, or give the money to a professional advisor or a fund manager so that he can invest only in good stocks. The biggest secret of risk mitigation is avoiding wrong stocks, which is very easy theoretically. But when the markets are excited, stocks are going up every day, this is very difficult to practice. So one who masters the art of avoiding wrong stocks reduces the risk of stock markets very meaningfully. So to summarize, there are three kinds of risk: market risk, valuation risk, and the stock specific risk. As I have discussed, the market risk is manageable if you have a long term view. Valuation risk is also manageable because it can only potentially reduce your potential returns. What is the key risk is the buying of wrong stocks. One has to be extremely careful of that, and if you handle that by investing only in right stocks through your own research or through a professional advisor, the risk associated with stock markets will be substantially lower, and more number of Indian people will invest in stock markets with higher allocation and participate in the wealth creation which we have seen over last several decades and which I am sure will continue for several decades. Thank you.